All right. Well, welcome everyone to the March edition of our market commentary. We're really excited to do this one. There's a lot going on in the markets. So, we're going to be covering a lot of different areas. But before we get into that, I wanted to quickly introduce my counterpart here. We got Evan. Evan's going to be helping me going over all of the information today. Evan is a certified financial planner, one of our newest advisors here on the team. Really excited to have you, Evan. Tell me, what do you think is going on in the markets right now? What's going on in the stock market?
I think everyone can agree the main thing going on right now is all these proposed tariffs. It has a lot of different impacts, not only on the markets, but on inflation. And I think that you have a full presentation on that on our YouTube page currently. So won't go
I
too
do.
into detail, but that is the big news in the markets right now. And that's what's causing a lot of volatility. And we've already seen a little bit of a correction here these past couple of days and couple of weeks. But the really important thing to keep in mind is that volatility is normal. So if we take a look at this chart here, what it's telling us is that a average of having a correction of 14% in the market is normal. And there's a couple different years that we can take a look at here that I think are indicative of what's going to happen here this year. And one of those is looking at 2009, where there was a correction of 16%. But then by the end of the year, the market ended positive 13%. And I think that that's something that we can see similar this year, where there's going to be a lot of turbulence, a lot of news events that spook the markets. But we are cautiously optimistic that the market's going to end positive. Nothing like the last couple of years that we've seen, where it's nothing plus 20 is what we're expecting, but something in this range, I think, is what we're expecting going forward.
So Evan, what I'm seeing here, just for the listeners and viewers, right, on this chart is these red dots depict how much of a decline the market suffered in that year, and the gray bars represent where that market finished up.
Exactly. The red mark is the lowest point during the year, and the gray bar is where it ended at the end of the year.
Okay, so like in 2000 and call it 18, the market dropped by 20% in that year, finished up down -6.
Exactly.
Okay. And if we look at 2003, the market dropped by 14%, finished up 26% up. So essentially the market is prone to significant decreases at any point in the year. And that's kind of what we're seeing right now. What makes you optimistic that this year will be similar? You said, you kind of pointed out 2009 market dropped by 16%, ended up with a 13% positive. What makes you optimistic that we're going to finish up the year positive?
There's just a lot of historical trends that we see repeating. And one of those trends that we see repeating is how much money is in cash. Where if we look at December of 2024, there was 6.8 trillion in money markets, meaning there's a lot of money on the sidelines. People saw this correction coming, where people saw that there was some overvalue in the stock market, some turbulence coming up. So people put some money on the sideline. But going forward, is that a good idea? Should you keep your money in cash? Should you be invested in the market? And the answer is it depends. But historically speaking, whenever we see all-time highs in money markets, the U.S. stock market performs well. So if we look at after the tech bubble burst in the early 2000s, there was another peak in money markets, and the following 3 years, the market was up on average 16% per year. Same thing happened in '08, where market people were spooked, rightfully so. A lot of money in cash. But then the following 3 years, the market was averaging 19%. And same
Got
thing
it.
post COVID, averaging 12%. So the common theme here is when there's a lot of money in cash, there's money to be able to buy these dips, which kind of leads to better market performance.
So they call it dry powder.
Dry powder, that's right.
Have you heard that term before, Evan?
Oh yeah,
So lots of dry powder on the sidelines to buy these dips. That's kind of what you're seeing?
exactly.
Yeah. Okay. What about long term, right? What we're kind of seeing is a correction, from my understanding, right? Corrections are 10% down markets. I don't know if we're there yet, but we're close. What defines a correction versus a bear market? How should we be looking at this from a long term perspective?
Yep. So the last chart was kind of short term perspective, and this is long term perspective. So what a bear market means is the market is down 20%. So if we take a look at what's happened in history after a bear market, I like looking at the tech bubble prior. So when the tech bubble burst, the market was down 45%. But then the following 5 years, it was up 108%. And then
Got it.
when '08 happened, market was down 50%. But then this tear that we've seen over the last almost 20 years, the market's been up about 450%. And we've seen a similar trend when we've had these bear markets during the COVID, et cetera. So the point here is if we're able to have our funds in a long-term bucket, we want to be aggressive with those funds because of this long-term growth.
Okay. And is it correct to point out that this chart is also capturing the amount of time that these bear markets went on for, and the average that is across all of these going back to the Great Depression is a year and 2 months ish?
Is how long the bear market happened for, correct?
Right. And then obviously a pretty steep decline in these bear markets. 39% is the average down. Now, a lot of that is weighted by 83% down in the Great Depression. And then I guess you would call the second worst is the Great Recession, which is 51%. If you take those out, you're probably at an average of, call it, 30% down. And maybe should I suggest less than a year of duration? Because the Great Depression's got the 2.8 factor here in the duration. So they're very brief moments of contraction. And then what am I looking at, Evan, in terms of like what's happened 3 months later, 1 year later, 2 years later? Like how do these things kind of spin out?
Yeah, taking a look at the 1 year later, on average is 21%, but that varies so much. I don't think that's a great indicator going forward. But the 1 year later, I think, is a better indicator just because there's a little bit more, it's a little bit more constant. But I mean, this makes sense, right? It's the golden rule: buy low, sell high. So
Yeah.
what this is saying is when there's a big correction in the market, it's a good time to buy and the market corrects itself. So 1 year
Got
later
it.
after the trough is we can on average 45% a year later.
Yeah. Yeah. Which is ridiculous returns if you stay in, right? But the question is always, how long is this market going to slide? Is this a correction? Is this a bear market? At this point, I think it's difficult to define what will happen. I think we are definitely going to approach that correction phase here soon. And if I'm not mistaken, right, Evan, we got a chart about it.
Yeah, and there's a lot of different stories going on this chart. I think the main story is in the top left, the large growth, the top 5 companies in the S&P 500. This is what we've seen coming for a while. We saw those really high price to earnings ratios. We thought that they were overvalued, and we're starting to see them come down a little bit.
Where's that money going, Evan?
It's out of the stock market where we've seen the price has come down out of those large the top 10 in the S&P 500, and we're starting to see a shift towards the rest of the 493 that are in the S&P 500, which are more value companies where the price to earnings ratio is a little bit closer to the mean.
Right. So if I'm looking at this, I'm looking at significant decreases across the board on the growth side of the market. It's rotating over to value, which we've been calling for 6 to 12 months. But what I'm also looking at is a strong surge in international. Year to date, international is up almost 10%. I mean, we haven't had a strong international market in a while, and that would go contrary to what people would have thought with all of the geopolitical risks stemming out of Europe. To have a 10% increase in international when the US market's getting so beaten up. Is this just on rotation, you think? What do you think's driving this, Evan?
I think we also saw this coming too because just the price to earnings ratio for the U.S. stock market versus international. We also saw that there was an opportunity there, um, but this chart is talking about the price to earnings ratio of the S&P 500 and that shift we were talking about earlier, where we saw that the price to earnings ratio really went off the charts these past 5 years. But if you look at that little line at the end of the green, we're starting to come down with the top 10 companies in the S&P 500 where they're trending towards becoming more normally valued, and the
Right.
rest of the 490 are trending upwards towards the mean. They're both heading towards that mean, which makes sense and was what we were expecting.
Right. Right. So to summarize, right, we've got the S&P 500, which normally through the last 30 years is traded at 16 times earnings. That's, appears overvalued at 21 and a half. So we're seeing a correction just across the S&P 500, but most of that is happening in that growth space, which is captured a lot by, heavily by these top 10 stocks, which are mostly all growth names, and that side is contracting clearly in way more of a contraction than anything on the remaining stocks versus the S&P 500. You're seeing a down trend there, as well as in those top 10 positions. So understood. We've been talking about that for a while. I wasn't sure when we were going to see it, but now we're finally also starting to see the rest of these names in the 500 index of the S&P 500, right? Actually, and this is for a brief moment in time, but actually outperform the Mag 7. We haven't seen this yet either. This was a snapshot by BlackRock early on in the year. Now, this was when markets were positive at that time. You could see that Mag 7 was trailing all 500 stocks pretty much across the board in terms of the index, the S&P 500. Additionally, we're seeing the theme and rotation come into international stocks. Now, we also mentioned this, which is why we added to our international exposure at the end of last year, beginning of this year. We added a few percentage points onto the international side, which we do use an active fund for that because we do believe that the index as a whole, international, is a tough one. There's a lot of bad companies that make up the international EFA index, as well as some of the other indexes. We do believe in active management in the international space. So if you're going to take a bet in international, try to use a fund. That's what we recommend. But the reason that this theme is likely playing out this year, where international is up almost 10%, the rest of the market is down, or value is the only thing that's actually up 1%, is because look at the P ratio again, we were at 21 and a half times P ratio versus international, which is 13.7, right? The 20-year average of international is 13. So it's not like we were seeing this exuberance on the international space. In fact, international was correctly priced compared to the 20-year average, whereas US stocks have really gotten over their skis. And never have we seen in the last 20 years a discount on a PE ratio. And again, when we talk PE ratios, we're talking about the price versus of the stock or the stock index versus the earnings that that stock or the index that is represented earns, right? Never have we seen this steep of a discount. We're seeing US market, the generally 20-year average is around 16, price at 21 and a half. We're not seeing that big disparity in international. So from when you compare US versus international, steep discount here in February. We're in the doldrums of basically the lower ends of that standard deviation, which is why you're seeing, I think, the international markets get snatched up here, even though that it would be contrary to kind of public opinion here with the war in Ukraine, all of the turmoil that's being set forth by the comments that we had from the current administration. We would have thought, or the normal thought would have been international would be, a bloodbath right now. But in fact, it's actually one of the only segments of the market that is performing positively. Isn't that interesting, Evan?
It is interesting. And I think it's important to note that with all the volatility and question marks going forward, you're not putting all your eggs in one basket, but to have a little bit of a shift to buy some value, I think makes sense.
Yep. And a little international. So we're getting more constructive on this space. And right now, our portfolio in terms of equity holdings holds right around 12% in international, which is the highest that we've been in international, again, in years. So will this trend continue to play out? That's yet to be seen. But I think with the disparity in PE ratio, I would not be surprised if international ends up leading in terms of performance for this year. We'll see if there's other shocks, other shoes that would drop. Obviously, if these tariffs were to be instituted and create havoc over there, we could see a reversal. But right now, that's not what we're seeing, even with the lofty tariff expectations that are being put on by the Trump administration. So, with that being said, Evan, talk to me about bonds, my friend. Bonds, we've been talking about for a while as a team here, but bonds have really been stuck in the mud. Why is this year the year potentially for bonds?
Yeah, and I think the where we should start is looking at historical trends. So what this graph is showing us is what happens to bonds and also the S&P 500 when CD rates are at a peak. So the 6-month CD rate being at a peak, what happens to bonds in the S&P 500 the following 12 months? So looking at the tech first, what happened was CD rates were at all-time highs, but the bond market performed better over the next year, getting 13%. In '06, it was pretty similar. In 2018, the stock and bond market really outperformed the CD rates. So the general trend here is when CD rates are attractive, people are putting their funds into CDs and money markets. The bond market actually outperforms, um,
Interesting.
which makes sense on a long term basis. But it's interesting to see that that happens on a short term 12-month basis as well.
And is that mainly because, you know, at the peak of CD rates, that's essentially the peak of the Federal Reserve's interest rate tightening campaign, which sets forth then the future is going to be a reduction of interest rates, which is a catalyst to the bond market. Is that a good way to view this?
Yeah, that's a
Ron?
really good point. So when interest rates are up, bonds weren't performing well then, but then when interest rates start to come down, meaning rates hit their peak, rates start to come down, to your point, bonds perform better.
Right, right.
That's exactly what that graph is showing. Now, something to note is there's a main con to bonds versus money markets and CDs. Is with money markets and CDs, that rate is guaranteed, but with bonds, there is fluctuations. And that's what this graph is showing here. That um, same as the graph we are looking at earlier in our presentation, intra year, the bond market might be down a couple of a percent, but the gray bar on top is showing where it ends at the end of the year. So just keep in mind that volatility is also normal for bonds, but long term, bonds are going to perform better than money markets and CDs. And if we look
And,
at the averages, if we look at the 3-year average, bonds still don't look good because of that first circle that you had there, where bonds were down 13% um, after the year when we saw those very significant interest rate increases.
so we're coming off literally in modern history the worst year for bonds, and we really haven't seen much recovery in the bond market in the 3 years after that. Talk to me a little bit about what's going on this year, Evan.
This year, we finally seen the bond market do well, where the bonds are doing what they're supposed to. When there's volatility in the stock market, the bonds are performing well. So year to date, if we circle that middle column, kind of looking at the general average of bonds, they're up about 2%, which is exactly what they're supposed to do. Now, again, looking at that 3-year average, they're not looking great because of the major interest rate increase, but going forward, closer to the 5% average is what we're expecting.
So
Uh,
year to date, I mean, if we take a look at the blend of this, right, we're at, if we circle in snack dab in the middle, we're at 2.5% in just the first 2 months of the year on bonds, which we've been talking about for a while, right? That bonds would finally come in and play a part in a 60/40 portfolio, right? Because once interest rates come down, and they had to eventually come down, right? Then bonds start to accelerate and really provide that cushion if the stock market starts to roll over. And that's truly what we're seeing, right? What do we think then, Evan, about bonds long term, or at least over the next couple of years? What are we seeing there?
yeah, I think what we see going forward is closer to that 5-6% average. Where if we look at real yields right now, and real yield is just the 5-year U.S. Treasury bond minus current inflation rate. If you look in January, the real yield was at 1.4, and the last time we saw real yield around that area was in February of 2015. But what can we expect when real yields are between 1 and 3%? It's that 6% average is what we've seen in the past. And that's what we want from bonds going forward. We know they're volatile when interest rate environments are going out of whack, but long term, this is what we expect from bonds.
Right. So basically, what we're seeing here is when there's actually a return on investment over the inflation rate, bonds actually do very well in that environment, and that's what we're actually seeing here with inflation at this point, that it's trended down to the about 3% level, with rates still up on the higher end. We see a good projection moving forward, at least over the next 12 months. So folks that are in bonds right now, I think, are going to get a good return on investment over the next 12 and possibly the next 24 months, depending on how things shake out. So Really good information, Evan. Thank you for getting this all together. And I think this was really timely in terms of looking at what's working, what's not. But as we kind of slide out to the end of this presentation, I just want to talk a little bit about what we're getting in terms of client questions, people reaching out. The main things that we always kind of end this conversation on is, let's not get emotional about what's going on in the market, right? There are a lot of things flying at us. There are multi-sector changes in terms of tariffs one day, tariffs not the other day. Let's not get our entire investment strategy out of whack because of what's going on the political front. Let's stay diversified. This is why we include different assets in our allocations. Let's stay the course. And let's just know our time horizon when we're going to be using these funds, right? We don't want to make sure we don't want to have everything in the stock market if we're pulling on those funds in close proximity. So these are just some general strategies. But lastly, if we're looking at the tips to this environment, is maintain that balance between growth and value. We've said this time and time again, with the market getting top heavy in those top 10 stocks, it was really tilting towards growth. We're seeing that rotation underway. So be mindful of that concentration risk is all. Also, I spoke about this early in the presentation. Look at potentially some international diversification, but look towards an actively managed fund as opposed to going index in this space. And again, bonds are going to be your friend when things get ugly, and that's what we're seeing. We don't know if this is the start of a bear market, which is how we kind of opened up this conversation, or is this just a 10% correction? I don't think anyone has that visibility to see that. We did an entire segment on tariffs, and we saw in that research that we shouldn't be deeply concerned just yet about these tariffs, that there are historical perspectives where some tariffs were utilized and did not have a significant economic issue with them. Now, at these levels, this is where things can get a little bit dicier. But again, if this becomes a recessionary risk, which we would not label this as so right now, bonds are going to be your best friend there. So utilize them in your portfolio. And I think you're going to have a nice balanced portfolio going into this year if things get a little bit dicier. All right. So lastly, we'll just kind of close out. This video goes out to all folks, including folks that are still working in the federal government. If there's questions that you guys have that you want to sit down with someone on our team, we'd be happy to go through any of the questions up on the board. Obviously, if there's clients that are concerned, want to talk to any one of our advisors, we'd love to hear from you if you have questions. As far as our YouTube channel, we've been promoting this for a year now. If you're not subscribed, please subscribe to this channel. Obviously, you won't be able to be viewing this unless you're subscribed, but you might have just received a link from an email that we send to you and you're not subscribed. If you aren't, please subscribe, like our YouTube video, as it gets that algorithm out to the rest of the federal employees out there that need this type of advice on allocating their portfolios as well. So that really concludes our session. Thank you, Evan. As always, you rocked this one. Great info. Evan did all of the research on this one, so really appreciate the hard work that you put into this one.
Yeah, of course. And I forgot to mention at the beginning of our presentation, happy birthday.
Oh, thank you. That's right. It is my birthday today. We are recording live on that. So appreciate that, Evan. All right. Until next time. And we will be putting out some other videos on tax for the month of March. Please stay tuned. We got a newsletter coming out that is got some of those tax video links on our YouTube channel that are now live. But there's some good information on capital gains, other things that you need to know when you're preparing your tax return this year. So Again, hang in there. Don't get spooked. This is nothing that we haven't seen before in terms of a pullback, and you should label it as such as of this moment, right? Don't get too caught up on the news and things like that. All of the things that are being instituted right now by the current administration could be easily taken away, and we don't want anybody making long-term decisions on just such a short-term situation as of right now. All right. Take care. And until next time. Thanks again, Evan.
Thanks.